This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
And we are joined by Todd Lutsky from the law firm of Cushing Dolan for Ask Todd. This is your chance to ask Todd your questions about your estate plan. So we're going to open up the phone lines in the studio. The number here is 888-205-2263. That's the number to call if you want to ask Todd a question about your estate plan right here on the radio right now. That number again is 888-205-2263. 2263. So get calling if you want to be in line to ask Todd your questions. Mr. Lutsky, how are you?
I'm never better, and you?
I'm doing okay.
Oh yeah?
I've lost a little bit of weight.
Oh, that's good.
And people have been really complimentary to me.
Oh,
which
good.
is nice.
It's nice, yeah.
But I'm feeling just like I'm not really half the man I used to be.
Of course you're not.
So it's been kind of a mixed bag.
It's kind of a mixed bag for you.
Kind of a mixed bag.
You work on that.
Todd, let's talk a little bit about ownership of rental properties.
Yes.
What types of things do people need to take into account when they're determining the best way for them to own rental properties they may have?
Yeah, folks, this is probably one of the more complicated, aspects of real estate is rental properties, because sometimes people will take their rental property and they'll put it in their, they'll add a child's name to it. They say, I'll just own it with
their child or another child?
Well, probably one of their children's
Okay.
names. I hope they don't give it to a stranger, but if they wanted to say, like, I'm just going to add one of my children on because I want them to have this property when I die, it'll go there automatically when I die, and they think that's a great way to do it. I don't, and here's why. You put their name on it, and you don't realize that now you've made a completed gift. Okay, maybe there's a gift tax, maybe there's not. Depends on the value. And more importantly, if you've been relying on that rental income, you've just given away half the rental income. That's not something you think about, but you might give it away and then you continue to retain all the income. Well, that's not what you're supposed to do, but people do that. They don't realize that income follows ownership. So they continue to pick it up. And the IRS isn't usually too happy about you collecting all the income. If a child that would get some of that rental income might be at a higher rate, well, the IRS doesn't look too fondly on that. So be careful when you do that. But you know what, folks? That's not even the lion's share of the problem. Now you've exposed half the property to that child's creditors. I mean, what if everything goes well and that child gets divorced? Now you could own the property with an in-law.
That's everything going well?
Well, until the divorce.
Oh, okay. Okay.
And then you could own the property, halfway with an in-law and an ex-in-law, and you really don't want to be there for that, or any creditor, quite frankly. So enough about all the bad things that can happen. Oh, by the way, if you want to sell it, whose permission do you need? The other owner. So if that's the kid doesn't have to sell it. Now you've got this whole litigation problem associated with it. So, folks, please don't give away real estate. And the other issue is whenever you give away real estate, you're giving your children a capital gains tax liability if, in fact, you bought the property a while ago for a little and it's grown to a lot, or rental property you've bought and depreciated the basis over time and gave it to the child. You give the child your basis. You give the child a built-in gain. So not always the best way to go with real estate. What I would do with your rental property, though, please put it in an LLC. Remember, if someone slips and falls or there's a party and someone gets hurt on that property, they're going to sue the owner. And the owner is you if your name is on it. And then they're going to sue you personally, and all of your other properties, homes, vacation homes, and bank accounts will be at risk. If it's in an LLC, at least they sue the entity, the LLC, and not you personally. So you've reduced your creditor exposure by having it in an LLC, a much better way to go. So that's just one of the benefits of having an LLC.
All right, we got a few callers all queued up. Let's get right to them with Todd Lutsky. Let's go first to Kevin in Connecticut. Kevin, what's your question for Todd?
Hi, Todd. Thanks for taking my call.
Sure.
My question was in regard to stepped-up cost basis. My parents had quit-claimed their home into the boys' names, and they paid $40,000 for the home 50 years ago, and I'm just wondering where the stepped-up cost basis is. They do have life use of the home, and just looking for some guidance in that.
So how much is the home worth today?
$340,000.
Did they pass away?
They didn't. They're both doing well.
Okay.
They're 84 and 94.
Excellent. Okay, so here's the situation. This is what we talk about all the time, folks, with real estate. He Kevin in this case, saved this whole example by at the very end saying that, they do have life use. So what I'm going to assume that means is that they gave the home to the kids, but they reserved the right to live there, a life estate. Well, I don't love that approach from a planning perspective. At least it will provide the avoidance of probate. It will protect the asset from the cost of long-term care in 5 years. There's a lot of other creditor issues and things that can go with it, but assume everything else works out well. And finally, when they die, because they reserve this right to live there, they did not make a gift that caused the asset to be excluded from their gross estate. Having that retained life estate is like a string. They threw the house to the kids, but retain the right to live there. So when they die, the Internal Revenue Code, will pull that house back into their estate. So the whole $340,000 value will be included in their estate on the date of death. And it's that inclusion that causes the triggering of the step up in basis. So the kids will then get the house if they died today with a basis equal to $340,000 or fair market value on the date of death. So if the kids were to sell the property shortly after they get it, there would be zero capital gains tax due. So at least they saved the step up in basis. Whereas if they had given the property completely away and did not retain that little string, that life estate, then the situation would be different, and the kids would have gotten the basis of $40,000, which is what they are given when they make the gift, and then their capital gain of $340 minus $40, or $300,000, would be built in to that property when the kids sell it, making them not very happy campers. So please don't give away your property. And so, folks, understanding this real estate and how you own real estate, and life estate's just one of the examples in our guide this month, right? Called Real Estate, Who Owns It and How It's Protected, right? This is just one way of owning it. What about tenants by the entirety? What about joint? What about LLCs? We talked about that earlier, how they are used. Folks, so many people that do estate planning have real estate, and you need to understand how to fit that real estate into your estate plan from a creditor standpoint, a tax standpoint, a control standpoint. Folks, call and get the guide, 866-848-5699 or legalexchangeshow.com. Probably one of my favorite guides, folks, 866-848-5699 or legalexchangeshow.com.
Todd, we've got another call for you. Let's go to Michael in Boston. Michael, you are on with Todd Lutsky.
Good morning. Thanks for taking the call. I have an irrevocable trust that's about 10 years old, and my residence is in that trust. It's part of the trust.
Okay.
And I'm wondering, I'm paying, of course, the real estate taxes.
Sure.
I'm living here full time and so forth. But if I decide to sell it, my understanding is there's a table that tells you about your capital gain.
Did you reserve a life estate in the property, or did you just put the whole property in?
Life estate.
Yes, got it. Okay.
So how does that, if I sold today, what is the capital gain the same as it would be ordinarily when I get a $250,000 exemption and that's it? My understanding was that it gradually decreased as I get older. It's age dependent.
Do you remember if, when you set this up, the individual that set it up told you the trust is a grantor trust? Do you remember that term?
My trust is a grantor trust.
Excellent. So let me tell you, now I can tell you and everybody else listening, folks, if the trust is a grantor trust, which according to this situation it is, I know the kind that we draft at Cushing and Dolan are always grantor trusts, and why that is the most important part of this question is because of the tax ramifications that go with the trust when it's a grantor trust. Let me tell you, when you go to sell the property by reserving a life estate, by the way, one reason I don't do it, I would have just put the entire property into the irrevocable trust. I see really no need. Only 3 times do I ever reserve a life estate, which we've talked about in the past. Maybe that was one of them here. But so when you have a life estate and you go to sell the property, what happens is there is an IRS table that says how old I am. Number one, you get the interest rate. There's a code section 7520 that has an interest rate for the month in which you're selling. You go then to table S of the Internal Revenue Code with that interest rate, and it will give you and you go down one column and find the age of the individual, and you go across the table and you will see a life estate percentage and a remainder percentage. And whatever that life estate percentage is the proceeds that will come to you, and the balance will go to the trust when you sell it. Now, the good news here is that because it's a grantor trust, all of the gain associated with your life tenancy and the gain associated with the remainder interest all ends up on your personal 1040 because it's a grantor trust. So it flows through the gain, even though you don't take it. It flows through the gain to be picked up on your personal income tax return, thereby enabling you to get the $250,000 capital gains tax exclusion associated with the sale of the home, just like you would if it was your primary residence and not in a trust.
Mr. Lutsky, I think we're basically out of time for you today, so I want to thank you for joining us, and I look forward to speaking with you again next week.
That sounds great. Always a pleasure being here. Thank you.
The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing and Armstrong do not endorse each other and are not affiliated. This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. Evaluating how to smoothly pass along assets to your family is a huge part of a solid estate plan. Your home is most likely your primary asset, and if you think simply transferring it to your kids is the easiest way to go, you'd be taking a major risk, especially if they divorce in the future. Don't put yourself in an awkward position of having to buy back your own home just to protect it from creditors. Get Cushing & Dolan's brand new guide called Real Estate, Who Owns It and How It's Protected by calling 866-848-5699. There are better ways to own your real estate, and this guide will walk you through the process step by step, answer any questions you have, and put you in a more advantageous position to avoid probate down the road. Don't put your home at risk. Call today at 866-848-5699 and ask for your free guide, Real Estate, Who Owns It and How It's Protected. That's 866-848-5699, or you can request the guide online right now at LegalExchangeShow.com.